Hello, fellow investors. Today, I'm going to be talking about value traps and specifically how to avoid them. And in this video, I'll be using Walgreens Boots Alliance as a case study. WBA is a blue chip, very famous American company. They own a bunch of pharmacy businesses, including Walgreens in the US and Boots in the UK. They've been part of the Dow Jones Industrial Average for quite some time, but they're about to be replaced and taken out of it, probably due to underperformance and to the current size of the company, which has shrunk a lot. And they're going to be replaced by Amazon. So looking at this price chart, we can tell that WBA has, over the course of its history, been a success story. Rising quite a bit all the way until 2015, even though it went through a period of underperformance during these years. Since 2015, though, the company has been on the struggle bus, and the price of the stock is down almost 80% in just under 10 years. The company right now is worth about 18 billions, and it has a respectable dividend yield of 4.65%. However, this dividend yield used to be a lot higher. In January of 2024, I believe, is when the company cut the dividend significantly, just over here. And the dividend yield went from a staggering about 9% to the current 4%. Now, between the years of 2021, 2022, and 2023, a lot of dividend investors, a lot of value investors were buying heavily into this stock. And while in retrospect it would be easy to say that was a mistake, at the time maybe it did look like a good deal. At the end of the day, this was a blue chip company that had an almost 10% dividend yield and was probably selling very cheap on paper, with a low PE and a low price to free cash flow. This was a company that had raised its dividends for 47 years consecutively, and management, I'm sure, during the conference calls, had made no hints that they were going to cut the dividend. So how can you blame someone for thinking that this is a no-brainer investment? In this video, I want to go back and look at all the way until 2022 if there was a way to figure out that this was actually not a good investment, and that, if there were any hints that this was going to be a value trap. Was there a way to tell that WBA was probably going to have to cut its dividend, and that actually the quality of the company was not that high? If you're new to this channel, my name is Camille, and I run an independent stock rating platform called Rated A. Like other successful investors such as Warren, Charlie, Terry Smith, or Phil Fisher, I believe that one of the best ways to build wealth in the stock market is to find great companies, don't overpay, and then just watch your investments and passive income snowball. So what I've done is I've built this platform where I cover large cap stocks from several countries in the world, and I rate them based on the quality of the underlying company. And it's been demonstrated that higher quality companies produce better economic returns, and that over the long term, stock prices follow the returns of the underlying company. This is something that even Charlie Munger has said himself. So on Rated A, companies are rated on a scale from A to D, with A and B being very high quality companies and D being very poor quality companies. And these ratings are calculated based on three main components, which I think are the most important to consider the long-term success of a stock. The first is the moat, and moats come in various forms, like network effects, switching costs, intangible assets, and economies of scale. The second component is profitability, and that is pricing power, scalability, mission criticality, recurring revenue, low capex. Those are all things I look for. And profitability basically is how easily will the company grow in the future. And last but not least, the third component is safety, or in other words, risk. Is the company exposed to, large debt obligations or government regulation, litigation, patent expiry, and overall negative secular trends? So each company gets a score out of 5, and this goes into the rating. And I really believe that over the long term, buying high quality companies will serve any investor very well. So, if this philosophy is something that speaks to you, if you're a long term buy and hold investor, if you like dividend paying stocks, or if you want access to quality research on companies, join me on this journey. Check out Rated A. It's free for the first 2 weeks, so there's very little risk for you. I'll put the link in the description below. So back to Walgreens Boots Alliance. This is a very lowly rated company on Rated A. Receives an equity rating of D, which is the worst that any company can get. And on the right, you can see the different component scores, which are low across the board. 1 star for Moat, 1 star for profitability, and 2 stars for safety. We're going to get to explanations for all of these scores in a second, but first let's talk about what this company does. How does this company make money? WBA is a conglomerate of pharmacy chains. Famously, it owns Walgreens in the United States, but also another chain called Duane Reade, which I believe is popular in New York. And in the United Kingdom, the company also owns Boots, which is the largest pharmacy chain in the UK. Within those pharmacies, the company makes most of its money selling prescription drugs, as one would expect, but a significant portion of the revenue also comes from its retail business. In some cases, Walgreens acts like a convenience store selling little items here and there. Just because it's very conveniently located, Walgreens has locations all over the US, and there's a very famous stat that 80% of Americans live within 5 miles of a Walgreens owned pharmacy. On top of the retail and the prescription drugs business, Walgreens has been expanding their locations and adding some healthcare components to these locations. So now a lot of Walgreens offer primary care and urgent care services, or specialty pharmacy services, or even home care management. So they're really integrating the whole healthcare process into these locations to make them more attractive and convenient for patients. And lastly, on top of all of that, Walgreens or WBA also owns a wholesale business in Germany, which distributes prescription meds to other pharmacies and healthcare facilities like hospitals. So Walgreens is a very large company that's active in many different parts of healthcare. So let's first focus on the moat. Does WBA have real competitive advantages that protect it from competition? The first thing that comes to mind is the convenience. As I mentioned earlier, 80% of Americans live within a 5 mile radius of a Walgreens. That's very convenient, and convenience can be monetized. Because it's so convenient to buy, toothpaste from Walgreens, the company can charge higher prices for that toothpaste. The problem with this argument, in my opinion, is that within the last 5 to 10 years, the rise of e commerce, and specifically Amazon, as well as delivery companies like DoorDash, have sort of nullified this advantage. Now, the next thing for WBA is the addition of healthcare services to Walgreens locations. And the idea here is that you're keeping patients locked into the ecosystem and stopping them from going to, get their healthcare somewhere else. Now, this is certainly beneficial for people that live in remote areas. Again, it's very convenient. But what happens when technology improves and, for example, healthcare goes online? Does a medical practice that's run by Walgreens have more advantages than a practice that's run by private equity, for example? I don't really know. And here's the thing with the pharmacy business is that there is no differentiation. Whether it's a CVS, whether it's Walgreens or Duane Reade or Boots in the UK or any other independent pharmacy chain, they all look the same, they all feel the same, and they should, in theory, all offer the same service. As a patient, I go to the pharmacy to collect my medication. As long as the establishment has my medication, I don't really care what brand the retailer is. Whoever has a more convenient location relative to where I'm working or where I'm living wins. Now, the second thing is that compared to big box retailers like Walmart, Target, or Costco, Walgreens has very little scale. These other bigger competitors simply can get items for cheaper and negotiate better procurement deals for themselves. So, for a Walgreens location, the premium prices in store essentially get nullified by higher acquiring costs. Lastly, and perhaps most importantly, is that the healthcare industry is highly dynamic, and Walgreens is being pressured from every angle. On one side, there's drug manufacturers and wholesalers, which are trying to get the biggest fee that they can for their service. And on the other side, there's governments, insurers, and PBMs, which stands for Pharmacy Benefit Managers, that are trying to keep the prices down as low as possible. I'll spare you the details. If you want more in-depth analysis, you can just click on the read more here, and an entire page will show up. But a summary of what's happening these past few years is that the PBMs have consolidated and have a bigger bargaining power against pharmacies. And so pharmacies are getting a reduced fee every single year. The fee that they get for prescription drugs is going down. And this is reflected in the financials. If we look at the free cash flow margin, we can see that it's been going down for about the last 10 years. Now, in my opinion, the CFROI, or cash flow return on investment, is the single most important metric to measure the moat of a company. This is just an alternative to return on invested capital, or ROIC, but it uses free cash flow as the denominator instead of net income. I like to use this because, in my opinion, free cash flow is a better picture of the profits that a company is actually making. It's also more stable. So, in essence, if a company's cost of capital is between 8 and 10%, that means that Walgreens has pretty much been operating unprofitably since 2019. So, if we think of the title of this video and whether we could have predicted that Walgreens was a value trap, well, it seems that maybe from 2019, but definitely from 2020, it would have been possible to see that slowly but surely WBA's moat was eroding. WBA is currently selling for $21. Back in 2021 or 2019, the price was as high as the 50s. So, in essence, selling at that point would have saved us about 50% of our money. Overall, all of these changes, whether it's the rise of e commerce or the consolidation of PBMs, have led to overall less profitability for this company. And looking at the revenues, it looks like Walgreens has been selling more volumes of prescriptions, more retail items, etc., etc. But because the margins are being pressured so much, free cash flow is just becoming lower while revenues are increasing. And that's just devastating. What we can also see is, this new strategy from the new CEO of opening healthcare centers within Walgreens locations is very costly. CapEx, or capital expenditures, have just exploded in the last 2-3 years. And this also contributes to the free cash flow being so low. And finally, the last thing I want to look at is the dividend. Historically, you can see that the dividend was always at least 50% of the cash flow that the company was bringing in every year. But in 2022, the cash flow and the dividends were roughly equal. This means that Walgreens made X amount of money and paid the same amount in dividends to its shareholders. And if you knew that the company was going to have to keep on investing in opening these new medical centers, then you would know and you would expect that the dividend would be cut the following year. On top of that, if you look at the interest coverage, or how easily Walgreens can pay off its interest payments with current free cash flow, this ratio has just been decreasing year after year. And in 2021 and 2022, this ratio was at 10 or even below. So all of these were signs that the company, A, was not of high quality, and B, might have cut its dividends in the near future. Hopefully, that explains why the component scores for Walgreens were so low and why the equity rating is a D. I spared you some details, but if this is a company that interests you, you can definitely have access to this by signing up to Rated A. If you're still listening to me this far into the video, first of all, congratulations. And second, I'll give you a little gift of some valuation predictions for this company. This is my custom 10-year total shareholder return calculator. Based on the assumptions that I put in, it'll show me what return I can expect for the following 10 years. So here we go. I've prepared this ahead of time to save you some time. I've put in today's price approximately. And for this calculation, I've put in, let's say, some very rosy assumptions. We got 4% revenue growth, which is what Walgreens used to do historically back in the middle of the 2010s. Again, I've put a 4% margin, which right now Walgreens is nowhere near that. But historically, they've been able to do that. I've also assumed some share buybacks and a average terminal multiple of 14. And I've also assumed 5% dividend growth, which, seems kind of fast, but since they've cut it, it could be possible. If all of these assumptions take place, then the yearly total shareholder return is a staggering 23%, which at this price could make Walgreens a good buy. However, if we put in some more conservative assumptions like 2% revenue growth and 2% margins and a lower multiple and a lower dividend growth rate, this can easily go back down to 10, 11, which is, the market rate. And at this point, the risk reward ratio just wouldn't be worth it. The point of this calculator is just to say that, there's no right or wrong answer in valuation. Everything depends on the value, on the assumptions that you put in as the investor. The crazier and the more extravagant your assumptions, the better your return might be on paper. And of course, the more conservative you are, the lesser the return will be, but the more likely it is that that will happen. Personally, I would not put my money into this company for the long term, even if the deal seems attractive based on today's price. Value is very important when you are investing. At the end of the day, you're paying for a portion of a company's cash flows and dividends. So a higher dividend yield and a lower free cash flow multiple are more desirable than the opposite in absolute terms. The problem is that many times the deals that you think you are getting are not. The market is pricing these companies cheaply for a reason, probably because it expects the company to perform poorly in the future. And yes, the market is a manic depressive, like Benjamin Graham told us. But it's important to also respect the market. I've made the mistake in the past of trying to buy a good deal on paper, only to be disappointed in the months and the years that followed. In late 2020, Pfizer divested a portion of its business, its generic business, and merged it with a company called Mylan and created this new entity called Viatris. Many really good investors will tell you that spin-offs are usually a very fertile ground to find good deals in the market. Because what happens is that these new companies appear in fund managers' portfolios. They have to sell because of the requirements of their fund, and that pushes the price down on these spin-offs. That's exactly what happened to Viatris, you could say. What I realized over time, though, is that there were lots of headwinds for this company. There's no moat, the profitability is low, and the company also had a lot of debt to pay off. The result is that over the past 2, 3 years, the stock has gone nowhere but down. All of the great investors teach the same lesson. It's better to be less active in the market, to find good companies, to buy them at a fair price instead of an attractive price, and to hold them for a very long time. Over the long term, quality matters much more than value. Think about it. Would you rather buy a dollar for 50 cents, wait till the value readjusts, and then sell for the dollar? In a sense, making 2 times your money? Or would you rather buy a dollar at full price and see it grow to become $10? Deep value, or buying a dollar for 50 cents, can work, but you have to be very active in the market. You have to be on the lookout for deals. You have to know when to sell. You have to pay higher taxes and fees. That's not Rated A's philosophy. So even if you think that WBA is a good deal right now, if you share my philosophy of investing in quality companies over the long term, you might be better off finding A rated or B rated companies selling for a fair price. That's it for this video. I'll see you in the next one.